Hello everyone, thank you for joining our online learning. In this lesson and the subsequent ones, it's a series. We're going to cover consolidated financial statements. So all aspects of group accounts, we'll be looking at it, which is very important for our exam. So a recap of the standards that are relevant are: we have IFRS 10, Consolidated Financial Statements. This standard provides guidance on how we consolidate. We have IFRS 3, Business Combinations, how we determine the fair value of assets at acquisition, how we determine goodwill or how we measure goodwill. IAS 27, Separate Financial Statement, talks about how we measure or we account for investment in the individual accounts of the investor, be a parent or a normal investment. And then the IAS 28 talks about investments in associates. So let's begin by looking at the types of investments that would cover. We have investments which arises between a parent and a subsidiary. So for a parent and a subsidiary relationship, the standard that covers it is IFRS 10. Now for an associate relationship, we have IAS 28, and then also subsequently when you go to the advanced, which is the corporate reporting, you'll be looking at the other aspect of IFRS 11, joint arrangements. Now we're starting with a subsidiary. Now the IFRS 10 defines a subsidiary as an entity that is controlled by another entity. A subsidiary is an entity that is controlled by another entity. So the emphasis here is on control. The emphasis is on control. Now, if we say an entity is being controlled, let's say we have entity A, and we have another entity B. So B is controlling A, or you would say that entity B controls entity A. How? It's because entity B have what we call controlling interest. And the controlling interest means that entity B owns the majority of the ordinary shares in A, and that is what it means to have a controlling interest. So entity B controls entity A. Now specifically, when we go to the IFRS 10 position, it says that control is where the investor here is the entity B, has all of the following. So before there will be control, the investor entity B should have power over the investee to direct relevant activities. What is that power? It is the power to govern. All the relevant activities, and by relevant activities we mean operating and financial. So all aspects of the entity's operation is being controlled or is being governed by the investor, and the investor is entity B. So there should be power to govern. Very important. Power to govern. And power to govern also means that because entity B owns shares in A, entity B would have majority of the directors on the board of entity A, and it's the only way entity B can have the power to govern. Because if they do not have majority of directors, they cannot have that power to govern. The next one is that the investor entity B is exposed, so there is exposure or right to variable returns from its involvement with the investee. So it means that entity B is not promised a fixed return, and this return, which is a variable, is dividend. So entity B is not promised a fixed return on the investment in entity A. It keeps changing, and sometimes they might not even get dividend, depending on the performance and also the policy of the management or directors. So, and also entity A, because it's being controlled by B, B has the power or the right to affect the level of returns it wants to receive. So, for instance, where entity A is not performing well, entity B can say that I'm giving you a loan. Use the loan to work so you can improve on your performance. Or I'm providing you with a management service. So entity B will provide management services to entity A so that they can improve their performance. So entity B has a right to affect the level of returns it obtains from entity A. That is control. And lastly, entity B has the ability to use its power over the investee. So ability to use the power over the investee, ability to let's say terminate the appointment of all management personnel if they are not performing well, ability to affect key parts of the operations, either to curtail some of the operations or to expand. So these three elements are necessary for us to establish that there is control under the IFRS 10. Now, we're saying that there is a subsidiary and a parent relationship. So in this case, we are looking at B, entity B being the parent and entity A being the subsidiary. Now, from the concept of control, we're saying that entity B should have controlling interest. So entity B should own majority of the shares. But the concept that is embedded in the principle of control is that control is not limited to the majority interest. So the control from the concept of the IFRS 10 is not that the entity B should own more than 50% plus, or should own more than 50% of the shares. Entity B can still have control if other aspects of policies are in place. So for instance, entity B can have less than 50% of the shares, of the ordinary shares, or what we call the voting shares. Entity B can have less than that and still have control. How? Where there is an agreement with the other shareholders such that entity B would control the operations. Sometimes it is possible that entity B would make or advance loans to the entity A, or provide management services, and because of the valuable services they are providing, the other shareholders can agree that even though entity B is not owning more than 50%, they should control, they should have majority representation on the board. So where entity B has the ability to appoint majority of the board of directors, even if they have less than 50%, we say there's still control. And once there is control, there is a subsidiary and a parent relationship. Or where entity B casts majority of the votes, that would indicate control. Or again, when entity B governs the financial and operating policies of entity A, that is control. The last one is where we have indirect investment. Now, when we have indirect investment, this is what it means. We have entity B, we have entity C, and we have entity A. Let's say entity B have investment let's say, owns 80% of the ordinary shares of entity C, and entity C in turn own about also, let's say, 70% of the ordinary shares of entity A. Now, if you look at this carefully, entity B is only investing in C, not in A. But because entity B controls C, entity B indirectly controls A. So through indirect investment in A, entity A would be a subsidiary of B. So B has no direct investment in A. However, because B had an investment in C, and C also have an investment in A, B indirectly controls entity A. Therefore, entity A is a subsidiary of B. That is what we mean by indirect investment. So entity B has zero investment in A, but because entity B have investment in C, entity B would control entity A. Very well. How about associate relationship? Now, under the standard IAS 28, investment in associate and joint ventures, it says that an associate is an entity over which the investor has significant influence. So here is no control, it is significant influence. Now, what does significant influence means? The standard says that significant influence is where the investor has the power to participate. The investor has the power to participate in the financial and operating policy of the investee, such that the investor will have a representation on the board of the investee entity. So you are looking at entity, for instance, let's look entity B and A again. Now this time entity B owns about, say, 30% investment in A, and because 30% is not majority of the shares, entity B cannot control A. Instead, entity B only have significant influence over entity A. And what it means is that because entity B has investment, entity B is allowed to appoint directors to the board of A, and by that, entity B can participate in the financial and operating decision making of entity A. So we say there is significant influence. Now, under the standard IAS 28, there is a presumption that investments of between 20% less than or equal to 50% constitute associate. There is this presumption, unless otherwise proven that it is not an associate relationship. So when we have investment of 20% or more but less than 50%, then we're saying that the investment creates an associate relationship between the investee and the investor. It is not a parent and a subsidiary relationship. So we're looking at the fact that where there is investment of 20%, so if you look at it here, this is 30, and if it's 30, it's more than 20%. So we can conclude that entity B has significant influence over A, and because of that, entity A is an associate of B. Very important. And like I've said earlier, by significant influence means that entity B would have representation on the board of directors of A, and by that, entity B can participate in the policy decision making processes of A. Entity B can transact with entity A. Entity B can also provide management services to A, and also other essential technical services. And all of this gives entity B the power to participate in the financial and operating decision making of A. Now, we're going to look at a couple of examples and see how each of these creates a parent and a subsidiary relationship, and also an associate and an investor relationship. Now, if you look at this example, we have entity A purchased 100,000 of the 150,000 Ghana ordinary shares of entity B. Now, what it means is that we have to establish the interest, the controlling interest. Now, the controlling interest will be the number of shares entity A acquired in B, and that would be the 100,000. So the interest will be 100,000 divided by 150,000, and that gives us 67%. Now, 67% is more than 50%. So the 50% plus, this is 50% plus, indicates that there is a subsidiary and a parent relationship. So what is our conclusion? Our conclusion is that by virtue of the investment, entity A becomes a parent, entity B becomes a subsidiary. And because of this, entity A controls B through the 67% investment in the ordinary shares. And therefore, when entity A is preparing its consolidated financial statement, entity A should consolidate entity B. So entity B should be consolidated. And how does it happen? It means that entity A should add the assets of the entity B to its own assets. Entity A should add the liabilities of entity B to its own assets. Same way, where we are looking at the financial performance, entity A should add the income or revenue of B to its own revenue, should add the expenses of B to its own expenses. However, a key principle we'll be looking at subsequently is that where there is a transaction between entity A and B, we call such transactions intragroup activities. And all intragroup transactions are eliminated at consolidation. The concept is that because entity B is a subsidiary, call it the son or daughter of a parent who is entity A, you cannot sell to yourself. You cannot give a loan to yourself. You cannot move an asset to yourself. And because of this, you cannot make profit on yourself. So anytime there is a relationship or a transaction between A and B, we say that when we are consolidating, we ignore it and we eliminate it as though there have never been a transaction. And that will be a key principle throughout our lesson when we are consolidating a parent and a subsidiary account. Now, the next example, 2, we have entity A purchased 30,000 of the 120,000 Ghana ordinary shares of entity C. Here, to establish the interest, we would have 30,000 shares divided by 120,000 shares, and that gives us 25%. 25% is less than 50%, and because it's more than 20%, or you can say it's 20% or more, the presumption we have learned earlier would apply, and therefore there will be an associate relationship between the investee and the investor. So our conclusion is that we have investor A and the investee C, and investee C is an associate of investor A, and that they will be accounted for under the IAS 28, not the group account. Because where entity A is consolidating, entity C will be outside the group. The entity C will not be consolidated. The conclusion here is that entity A's account for entity 1 C as its investment. So entity A accounts for its investment in C. Unlike the earlier example where entity A consolidates the financial statement of B, here when we have an associate relationship, entity A accounts for its investment in C. So how? Entity A will only take a share of its profit or loss from the investment in C and account for it in its P&L. So in the P&L and OCI of A, entity A will only show one line item or a single line item called share of profit of associate. Now, when it goes to the financial position statement, we say that entity A would account for its investment in associate, and the investment in associate, we call it equity method. Equity method of accounting, or sometimes we say A should equity account for C, and this investment in associate, it will be under non-current assets, and the investment in associate is just that how much was the cost of investment, how much did A pay to acquire the 30,000 shares plus the share of profit, and that is the basic way to find the investment in associate, and we will build up on this as we take more examples. Now, the rules governing the consolidation is that under the IFRS 10, a parent should consolidate a subsidiary. However, a parent can exclude or is allowed not to consolidate a subsidiary when two things happen. One, where there is a lack of effective control. Now, what does it mean that there is a lack of effective control? It means that maybe entity A had 67% in entity B. Please pay attention to this example, very important. However, entity A sold 40% of the 67%, leaving 27%. What it means is that entity A, after selling the 40% investment, entity A no longer controls B, and therefore entity A cannot consolidate B, and instead entity A would have to account for it as an associate. Or say that entity A sold 55%, and 55% entity A will be left with 12%. And if it's 12%, then it means that entity A would have to account for it as just a normal investment in shares or equity instrument. So it will be an investment in equity instrument, and that, as we have learned under the IFRS 9 and IAS 32 financial instruments, the principles laid out in those standard is what entity A will use to account, because entity A has lost control. Or it is also possible that entity A will still have the 67%, but before these can be possible that entity A will not consolidate B, maybe entity A have lost majority of the directors on the board, even though they have the 67% control or interest. If they have lost majority of the board of directors, it means that effectively they do not have the power to govern, because when it comes to decision making, they cannot win, they cannot carry the day. They are not able to cast majority vote because they do not have majority. So it's important we know that entity A can have 67%, which is more than 50, but still would not have effective control. Now, the second point is that where the subsidiary is held for sale. So if the subsidiary is held for sale, then we use the IFRS 5, which is non-current asset held for sale and discontinued operation. So if the subsidiary is held for sale or the subsidiary has been disposed, then we can no longer consolidate. Or the subsidiary has been acquired with the intention of reselling. So we say it's a subsidiary held for sale. And if that is the case, then we cannot consolidate. Or A will be allowed not to consolidate B. Very important. Let's move on. Now we are saying that under the following point you will be looking at, A have no reason not to consolidate B. A must consolidate B irrespective of the following point or the following conditions. Please take note, these are not reasons for A not to consolidate B. The only reasons under which A will be allowed not to consolidate B are these two which we have looked at. But where these events or conditions exist, A must still consolidate B. Now, the first one is that what we call non-conterminous year end. And non-conterminous year ends very easy. It means that they have different year ends. The subsidiary and the parent have different year ends. So for instance, the parent have year end 31st December S8, but the subsidiary have year end 30th September S8. Different year ends. Now, where these different year ends exist, the principle set out in IFRS 10 is that A must still consolidate B with adjustments. And adjustment is only allowed where there is a 3-month period either before or after. So here there is a 3-month period before the end of the year for the parent. This is for the parent, and this is for the subsidiary. And the 3-month period is allowed either before or after the end of the reporting date for the parent. So here the subsidiary year end 3 months before that of the parent. Entity A is to consolidate B with adjustment for that period and also with relevant disclosures. Now, different activities. Maybe entity A is in oil and gas, and then entity B is a bank. They have two different activities. A must still consolidate B with appropriate disclosures of the activities of B. So different activities is not a reason for A not to consolidate B. Now the next one is where the subsidiary is located in a foreign country. So a foreign country means that we have a foreign subsidiary. A foreign country means that we have a foreign subsidiary. And even if the foreign subsidiary uses what we call foreign currency, there are provisions in IAS 21 which guides A how it would go about consolidating B. So we say that there should be a translation of the accounts of B into the currency of A before A would consolidate. And you'll be looking at that when we are doing the corporate reporting. That is advanced paper. So it is not a reason not to consolidate B, where B is a foreign subsidiary and the foreign subsidiary uses the foreign currency. And then also where we have different accounting policies. Different accounting policies is not a reason not to consolidate a subsidiary. What it will be is that entity A must translate or must convert or must re-prepare the accounts of B into its own policy before they consolidate, and also with appropriate disclosures where there are differences in standards or policies. Now there are specific exemptions under the IFRS 10 in terms of consolidation, where entity A ordinarily should consolidate B. Entity A can be allowed not to consolidate B for the following reason. And we say they are exemptions that A can apply even though they are required to consolidate. The first point is that if the parent is a wholly owned subsidiary, what does it mean? It means that entity A is the parent of entity B. Now entity C is the parent of entity A. Very simple. Now, under this circumstance, entity A can be exempted from consolidating B because its parent, which is C, so entity C is the parent of A. Here, 100% ownership. That's what we call wholly owned, 100%. Entity C owns all the shares in A. And by this, entity A is allowed not to consolidate B because entity C will consolidate both A and B. I take that again. Under this circumstance, where the entity A is a subsidiary of C, before entity A itself is a parent of B, and entity A is a wholly owned subsidiary of C, entity A can be exempted from consolidating the accounts of B because C, who is the main parent, will consolidate both A and B. The next point is the parent share are not publicly traded. So for instance, entity A is not a listed. Entity A not listed. It's not a listed company. So entity A not being a listed company can be exempted from consolidating B. The next one is the parent's own parent produces consolidated accounts. So here it's similar to the first point, just that here you can have less than 80%, less than 100%. So you can have 80% control. And once the own parent will consolidate both the subsidiary and the other subsidiary, entity A can be allowed not to consolidate B. And the last one is where the parent is a partially owned subsidiary and the other owners allow it not to prepare consolidated account. What it means is that entity A is, let's say, 55% owned by entity C, and because it is 55% owned by entity C, the remaining 45%, which are the minority, we call them minority owners. The minority owners agree that entity A should not consolidate B because at the end of the day, all will rest on the entity C to consolidate all of them. So please ensure you understand these exemptions that are applicable for the parent not to consolidate, or where the parent can apply these exemptions. Our next point is to look at IFRS 3. IFRS 3 spells out what we do at acquisition. IFRS 3 business combinations. The IFRS 3 business combination set out what we call the acquisition method. And under the acquisition method, the parent should go through these 4 steps in establishing that he or she is the parent and also determining the goodwill at acquisition. So the first step is identifying the acquirer. Now, when we say identifying the acquirer is often the entity who obtains control from the combination. You see, it is business combination. So after the combination, the entity who obtains control is the acquirer, and that entity becomes the investor. Now, in most cases, the investee, who is the one selling, would often receive proceeds, and the acquirer, who is the one buying, would often be paying consideration, will be paying for the business, or will be paying for the ordinary shares. So the acquirer is often the entity who obtains control under the business combination. IFRS 3 says that we have to establish or identify the acquirer in the business combination. Now, step 2 is to determine the acquisition date. Now, the acquisition date is critical in terms of consolidation, because the consolidation should start from the date of acquisition. So at what date did the control pass to the acquirer? So the acquisition date is the date control was achieved or control has passed to the buyer. So what is the date? And often, sometimes the investor would have existing investment before going on to purchase more shares in order to obtain control. So the control is the date on which the investor has the power to govern, and from that date we start consolidation. All right. Now the step 3 is that on the date of acquisition, we have to determine the fair value of assets and liabilities. So we have to recognize and measure all assets and liabilities assumed at fair value. So all assets and liabilities at fair value on the date of acquisition, including intangible assets which were not previously recognized by the investee, the subsidiary. And provided we can determine the fair value of the intangible assets, we recognize them. Also, where we have contingent liabilities of the subsidiary, which are only disclosures, IFRS 3 is saying that on the date of acquisition, those contingent liabilities should be recognized as liabilities, and those contingent liabilities will reduce the net asset of the subsidiary. Then step 4 is that we have to recognize goodwill, and where there is any non-controlling interest, we have to determine their value. And often when we say goodwill, we are saying that how much consideration, how much was paid to buy. So consideration paid. And if entity A, who is the investor, did not purchase all the shares, then we say there is a case for non-controlling interest. A non-controlling interest is the minority. So let's say consideration is only paid for 60% ownership. Then the non-controlling interest will be the 40% ownership. And these, like I've indicated earlier, they are the minority shareholders. What is their value? When we put these two together, this gives us the actual market value of the business. It gives us the market value of the subsidiary. So when we less the net assets, and when we say net assets, is the total assets of the subsidiary less total liabilities at the date of acquisition. So when we less net assets, then we have goodwill. And the goodwill is recognized in the group account, in the consolidated account, not in the accounts of the entity A, who is the investor or the parent. Goodwill is recognized in the group account. Now, it's also possible that the value we have here, so for instance, if we have 1,000 here, and the net asset is 800, then we have 200 goodwill. It's possible that the value of the business could be less than the net assets. And when that is the case, we have a negative here. And the negative is negative goodwill. But we often not recognize the negative goodwill in the accounts. And we say that it means that the business is undervalued. And it means that the undervaluation becomes a gain. And we say this is a gain on acquisition. And this gain on acquisition will go to the parent entity. And it becomes a profit that will be immediately recognized in the consolidated P&L. And in that case, we say it's a bargain. We say it's a bargain purchase. A bargain purchase. And a bargain purchase is where an entity is actually paying less than the actual value of the entity. So bargain, and this is very common in sport, where players are acquired, and if the purchasing club pays less than the value, then we say there is a bargain. It's bargain. It means that the purchasing club paid less than the actual value of the player. The same applies when we are looking at acquisition, where a parent acquires a subsidiary but paid less than the actual value of the entity. We say there is a bargain, and that becomes a profit on acquisition. So this is what we need to look at when we are beginning to consolidate. Now we begin with the consolidated financial statement. Then subsequently we look at the consolidated P&L and OCI. So to start with, we want to look at the consolidated financial position. Now, before we begin the consolidated financial position, we'd also have to look at the set out. What are the steps? Now, the steps is that we have to determine the group structure. What is a group structure? The group structure indicates the controlling interest. The group structure indicates the date of acquisition. So we have to determine the group structure. Now step 2, we have to draw up the pro forma. And the pro forma here, we are looking at the consolidated financial position statement. Consolidated financial position statement. And the step 3 is to come up with the necessary workings. The necessary workings. So we have some standard workings that we'll be looking at. Standard workings that are required when we are consolidating the financial position. So let's begin by looking at the pro forma. So the pro forma here, we are looking at the consolidated financial position statement. So here it means that the non-current assets of the parent will be added to that of the subsidiary. Now at acquisition, we say let's recognize and measure goodwill. So if there is goodwill on acquisition, the goodwill becomes an asset, and this is an intangible asset, as we have learned earlier. It's an intangible asset. Then we have the current assets. So again, the current asset of the parent will be added to that of the subsidiary. Then we have the total assets. Now the downside is the equity and liabilities. Now under equity, we have to show the share capital of the parent. So this is the share capital. The share capital of the parent. So share capital of parent. So it is only the share capital of parent that we show when we are consolidating. The subsidiary share capital is ignored and is often cancelled out with the difference of the consideration and the net assets. So the extra will be the goodwill. So the parent share capital is only what we consolidate. Then we have retained earnings. So the retained earnings of the parent plus some portion of the profit from the subsidiary is what we consolidate. So we'll show this as a standard working when we are doing the adjustment. And also where there are other components of equity, we can show that under the standard workings 5. So you can look at all items that fall under OCI. From P&L, OCI, all those items will normally fall under other components of equity. Then we have non-controlling interest, NCI. Non-controlling interest, the minority investment in the subsidiary. That is what we are looking at. And again, they have a standard working which is called standard workings 4. So workings 4 will be for non-controlling interest. Now the total of this give us the equity. Now we add the liabilities. So the liabilities, we have the non-current liabilities of the parent added to that of the subsidiary. We have the current liabilities of the parent added to that of the subsidiary. So our total equity and liabilities here should equal the total assets. So this is a simple pro forma just to capture your mind that we are consolidating. We are adding across the assets and liabilities of the parent, and also we are consolidating the retained earnings and so on. So we need to look at this pro forma. It's a must learn, and as we progress and we are solving questions, you will learn how we can easily build up this pro forma from a given question. Now, the standard workings when we are consolidating the financial position are: number one, we have the group structure. Number two, we have the net asset of the subsidiary at acquisition and at reporting. Number three, we have goodwill. Number four, we have non-controlling interest. Number five, we have the group retained earnings. Number six, we have investment in associate. So these are the standard. What it means is that anytime we are consolidating a financial position, these workings are must do. And where we have an associate in the question, we must add the sixth working. So we have 5 basic standard workings plus a sixth one when we have an associate relationship. Now, where we have other adjustment, then we add up the necessary workings. But the basic ones for the consolidation are: 1, group structure, net asset, goodwill, NCI, retained earnings, investment in associate. Now let's look at each of these workings in turn, starting with the group structure. So the group structure workings 1, we need to draw it up and it will give you a good focus as you are consolidating, even though marks will not be awarded. Now, the group structure indicates the relationship between the parent and the subsidiary. So the group structure indicates the controlling interest. So here, if we have entity A, who is the parent, and entity B, who is the subsidiary, entity A has 60% interest in B. And what it means is that the NCR, who are the minority, they have 40%. Now, again, the same group structure will indicate the date of control, and which is very important under the IFRS 3. So the date control was achieved. So we are looking at the date of acquisition. Acquisition date is very important as we are consolidating. So what we often say is that entity A and B are in a group. So this is a group. They are in this group. Now, if we have entity C, which is an associate, is outside the group. Now, being outside the group means that entity C is not consolidated. That's what it means. And entity C will be equity accounted for under IAS 28. So the group structure would also give an indication where there is an associate. So the interest of the associate would also be shown, and the date of acquisition of the associate would also be shown. Very important to draw up the group structure to start with. Now let's look at some of the details that we can find in workings 2. Now for workings 2, very important. So I will have 2 pro formas for workings 2. Very important. Now, this first pro forma for workings 2 is needed when we are asked to calculate only goodwill at acquisition. And in most cases, when we are asked to calculate only goodwill at acquisition, it means that you will be consolidating profit or loss and OCI, not the financial position. And I need you to have a clear understanding of this, because you would have to understand that if you are asked to only calculate goodwill at acquisition, you don't need to show the net asset at reporting. So the pro forma we would have is that we need a share capital at acquisition, we need a share premium, if any. In most cases, if you don't have it, that is it. And the share premium is the treasury shares. Then we need a revaluation surplus at acquisition. We need a retained earnings at acquisition. So all of these very important to determine at acquisition. Then we look at fair value adjustment. Now the IFRS 3 says that there should be fair value adjustment for assets and liabilities at acquisition. including intangible assets which were not previously recognized, and also contingent liabilities which were previously not recognized by the subsidiary. What it means is that we can have fair value adjustment for assets which is above the carrying amount of the asset or below the carrying amount of the asset. So if we have below, it means that there should be a reduction in the asset value. So that will be in bracket. If it is above, it means that there should be an increase in the carrying amount of the asset to reflect its fair value. So there will be an addition. If we have contingent liability, which was a disclosure item at acquisition, we have to recognize it as a liability, and the contingent liability will reduce the net assets. And then when we have any intangible assets, we have to add it to have the total asset at acquisition. So when we do all of these adjustments, what we are getting is the net asset at acquisition. And this net asset at acquisition is needed to calculate the goodwill at acquisition. And like I've indicated earlier to you, the consideration plus NCI, if any, less net asset gives you the goodwill at acquisition. Now, the other form of the pro forma, which is number 2, is needed where we are to consolidate the statement of financial position. Where we are consolidating the statement of financial position, there will be no requirement to calculate goodwill, but you have to know indirectly that you need a goodwill as you can consolidate the financial position. So we would have to set out the pro forma in 2 columns, so that the first column, column 1, will be the net asset at acquisition, which is not different from this earlier pro forma. Then we need the second column, which is the net asset at reporting. And often all of these you can pick from the question that you'll be given. Now, the share capital acquisition would often be the same as the share capital at reporting. Then the share premium, if any, would often be the same. However, if we have revaluation surplus, the value at acquisition might not be the same at reporting, and you have to pick it from the question. Then the retained earnings at acquisition might also be different from the retained earnings at reporting, and you have to also pick it from the question. And as we do examples, you'll be learning these differences. Then the fair value adjustment, for instance, where we have a plant which is above, the value you have here will be the same value you bring here. However, the only other important area we'll look at is that because we have a reporting date, we have to show the fair value depreciation that arises on the fair value adjustment of the plant. So depending on the number of years since acquisition, we have to show the cumulative or accumulated depreciation on that. So if it is only 1 year since acquisition, we have to show the full year depreciation so that we can have the net asset at reporting, which is a reduction from the profit. Now, the other adjustment you would have is that if, and we'll be looking at this subsequently, if the subsidiary sells goods to the parent, there's what we call unrealized profit, and the unrealized profit will be in the books of the subsidiary, and that must be eliminated. So the amount of unrealized profit will be eliminated from the net asset of the subsidiary at reporting, and the difference will give us the value at reporting, which will be the net asset at reporting, and then plus any other adjustment depending on the question. Now, the reason why you also need the net asset at acquisition and at reporting is that we need to find what we call the post-acquisition profit, which will be shared between the parent and the non-controlling interest. So simple, if you have the net asset at reporting, which is CC, and we have the net asset at acquisition, which is BB, the difference between CC, so you can rewrite this as CC minus BB will give you the post-acquisition. And the post-acquisition earnings or a reserve, the post-acquisition reserve, would be what will be shared between the parent and NCI. So we have the pre-acquisition reserve, which is, for instance, this is pre-acquisition. What the retained earnings were before the parent acquired the subsidiary, what the revaluation surplus were, before the parent acquired the subsidiary. And then we look at the post-acquisition reserves, which could be the retained earnings and revaluations of losses, if any. Let's build on it. So we'll also look at workings 3, which is goodwill at acquisition. And I'll take you through the details or the element of the goodwill at acquisition. The pro forma for goodwill at acquisition is structured as: 1, we look at the consideration. So the consideration paid to acquire. Now there could be elements of consideration that will be given in the question. So the elements are: 1, we can have cash. So cash is paid to acquire the ordinary shares of the subsidiary. And often you don't have a difficulty with cash. We can have a share exchange. Often for a share exchange, the parent who is entity A, instead of paying cash, entity A will issue its own shares to the subsidiary as a means of payment. So you are looking at more like a barter trade. So entity A is paying shares to acquire shares. So we say it's a share exchange. So there will often be a ratio of the number of shares that entity A will issue in return for the shares that is getting from entity B. And we'll look at the details of that. So there is a share exchange. And often remember that whenever there is a share exchange, because entity A is issuing shares to acquire B, the share capital of A should increase when we are consolidating. Very important principle. Then the next one is deferred income. Deferred consideration. Deferred consideration. Now the deferred consideration is where entity A is promising that it will pay X amount in the future as a means of consideration. So entity A can say that I'll pay, let's say, 1 million in 2 years' time for the shares I have bought. In addition to the cash I've paid now, I promise to pay 1 million in the future, which will be 2 years or 1 year. In most cases, what we do when we are doing the goodwill calculation is that because it's amount which is promised to be settled in the future, we have to find the present value. So we discount it. So the present value will be the future amount times the discount factor. And often this is a simple calculation that we'll be learning using examples. Then the next one is what we call contingent consideration. Now we need to understand that contingent consideration arises where there is a condition. So there is a condition. Now entity A can say that I would pay entity B in 2 years' time only if entity B achieve, let's say, a defined profit percentage. So that will be the condition. So what it means is that if entity B fails to achieve that profit percentage, entity A will not pay. So we say it's contingent. It's contingent. The probability is 50-50. So at each year end, entity A have to reassess the likely outcome of that payment, and also the probability that it will occur. So often we look at the likelihood, which is the probability, times the future amount, which is often discounted. Now, the next point of the calculation is to look at the fair value. So if we say this is A, consideration, then B is the fair value of NCI, or we are using proportionate value of NCI. And fair value is making reference to the market value of the NCI. Proportionate value is where we take a portion of only the asset, the net assets. Now, this plus this, like I've said, gives you the market value of the subsidiary. Now, when we less C, which is the net asset at acquisition, remember we have seen this in workings 2. When we less it from the market value, we have goodwill at acquisition. And the goodwill can be positive or negative. And remember I said that when it's negative, we don't call it negative goodwill. We say it's a gain on acquisition. It's a bargain purchase. So like I've said, negative goodwill, if the assets exceed the consideration plus NCI, what the standard often requires is that the parent should relook at the consideration. Maybe the consideration fair value was incorrect, so they should first recalculate the consideration. They should recalculate the NCI. Then also they should recalculate the net asset. Maybe the assets were overvalued. Now, if after this recalculation and they still have negative goodwill, then we declare that such a negative goodwill is a gain on acquisition, and that gain will be reported in profit or loss, or where we are looking at the financial position, that gain will go to workings 5. Note that, very important, any incidental cost such as professional fees paid to maybe valuers or due diligence exercise that was carried out in order to determine the true value of the subsidiary, all such incidental costs are expensed to profit or loss. They are not capitalized as consideration. Please take note. So in exam, such costs can be what? Added to the consideration. You have to reverse that. Such costs should not be added to the consideration. So the incidental costs, all of which have to be expensed to profit or loss. Great. Now, the methods for calculating goodwill. We have two main methods for calculating goodwill. We have the fair value method and the proportionate or partial goodwill method. So we start with what we call the fair value method, which is the full goodwill method, and we'll look at the implication. What does it mean? We'll look at the implication. So here, when we are using the fair value method, it means that the NCI, the non-controlling interest, is measured at fair value. And often in the exam, we can determine the fair valuation. Sometimes we can be given the share price of the subsidiary that will help us to determine the fair value. Or we can be given the exact value of the NCI. Now, when we use the fair value method or the full goodwill method, it means that the goodwill we calculate is for both the parent and the NCI. And that if there is any impairment of the goodwill, it will be shared between the parent and the NCI. So just an extension of the pro forma. What you see here is the consideration, NCI at fair value, less net asset, we have goodwill. And like I've indicated here, this information will always be given in the question. Then we have proportionate. Proportionate or the partial goodwill method. Proportionate or partial goodwill method. Here, the NCI is measured at their proportionate value of the net asset at acquisition. And if we use the proportionate method, it means that the goodwill we will calculate is only for the parent. The NCI do not have a share in that goodwill. Their share, we say, is outside the consolidated account. And if there is any impairment of the goodwill, it is only attributable to the parent. It is not going to be shared between the parent and the NCI. So the same pro forma, just that here we have net assets, a proportion of it to go to the NCI. Now, let's see if we can draw up a simple example. Let's say we have consideration. And let's say the consideration is 100. Now NCI at fair value, let's say is 40. And the net assets at acquisition, the fair value of the net asset acquisition, let's say this is 85. If you have to put this in, and let's say the NCI or the consideration is for 80% control, and that will be 20% for NCI, non-controlling interest. So if we are to put this into this calculation, it means that the consideration is 100, NCI value is 40, we have total of 140, and the net asset fair value 85. Then we have a goodwill. Let's see, 140 minus 85. That gives us 55. And this goodwill is for the parent and the NCI. Now, if you go to the second approach, this time the consideration is still 100, but the NCI will be different. Now, look at it. Because we are using proportionate, NCI percentage against the net assets at acquisition. So 85 times 20% will give us the NCI value. So 85 times 0.2 will give us a value of 17. So if this is 17, it means the total value is 117, and 85 from this 117 minus 85, that gives us 32. And if it's 32, this goodwill is only for parent, and that's the difference. Very important. Now let's build on and look at the details of consideration. Like I've indicated earlier, the first component of consideration at acquisition is cash, and cash is cash. There's no adjustment for cash. But the second component, share exchange, is where we have to look at the number of shares that are going to be issued and look at where there is a split between the share capital and share premium. Often you don't have that problem in the exam. The total shares will be added to the share capital. And then the third one is the deferred consideration, where we are looking at the present value of the future amount, and the future amount would have to be unwinded, so we have to grow it back. So the present value have to be grown back to the future value. And often we say that if this unwinding interest is what we need to grow the present value, we charge it to profit or loss, or we deduct the interest from workings 5. And if we deduct it from workings 5, the double entry is that will add interest to the present value of the consideration, because this is a liability, so that at the end of the year we'll have a full value for the liability. Then, like I've said, the contingent consideration, it have to be determined at acquisition and remeasured at reporting date. So if at acquisition the consideration, which is the contingent consideration, have been determined at fair value, and that fair value is say 100, and there's a decrease where the fair value is 90 at the reporting date. This is at acquisition, the date of acquisition. This is reporting. If there is a decrease in it, this decrease is a gain, and that gain have to be credited to P&L and added to the retained earnings. But if we have 100 here and it has increased to 120, this becomes a loss, and the loss is needed to increase the liability. And know that the contingent consideration is a liability. Great. Very well. An example will help in this case. So a very simple question to test our knowledge. It says that what is the amount of the consideration attributable to Pantronic Co. for the acquisition of Sardonic Co. So let's see the details. On 1st August X7, that's the date of acquisition, Pantronic Co. purchased 18 million. So look at it, 18 million equity shares of Sardonic. The acquisition was through a share exchange. Look at it, share exchange of 2 shares in Pantronic for every 3 shares. So 2 for every 3. The ratio we establish is 2/3. If it were 3 for every 5, the ratio would have been 3 over 5. It's the number of shares in the parent divided by the number of shares in the subsidiary. So he's saying that it is 2 shares in Patronic, which is the parent, for 3 shares in a Sandonic. So look at it, 2 over 3. If it is 5 for every 10, it will be 5 over 10 in that order. So we have a share exchange. Now the market price of the share in Patronic at 1st August, which is the date of acquisition, was 5.75, and we need the market value to determine the value of the shares. Now Patronic will also pay in cash on 31st July X9. So we have to be able to determine from the date of acquisition to the date they will pay how many years away. Now this question is simple because we were given that it is 2 years after acquisition. If it is not given, you can easily know. Just count from the date of acquisition to the date they will make the payment. Now this clearly tells you that it's a contingent, it's a deferred consideration. It's a deferred consideration, and they are going to be paying in cash on 31st July X9 2.42 per share acquired. So we have to know the number of shares, which is 18, and the cost of capital is 10%, and because it's a future value, we'll have to discount it. So quickly, the consideration would be 1 share exchange, and the share exchange is the number of shares acquired, which is 18 million times the ratio 2 over 3 times the share price of Patronic shares. And please be careful, you can be given the share price of Sandonic, who is the subsidiary. We do not use that to measure the share exchange value. So here, let's see, it is 18 times 2 divided by 3 times 5.75. That gives us 69 million. Let's say in Ghana city, 69 million. Now the second point is the deferred consideration. So we need to determine the present value, and the present value will be the number of shares they have bought times the value they are going to pay, which is 2.42 times the discount factor using, so the discount factor here will be because it's in 2 years away, it will be 1 over 1.1 raised to power 2. So let's quickly do that. So you have 18 times 2.42, that gives us 43.56, and if you find the discount factor, which is 1.1 raised to power 2, 1 divided by answer, that gives us 0.8264. So that times 43.56, that gives us approximately 36 million. So the total of this will be 69 plus 36, that will be 105 million. So 105 million would be the consideration value, and that will be the option A here. So take note of that. So very straight away, this is how we're going to be looking, and this is an adjustment that we would be making in a full question, and it's important we understand the details from this perspective. Let's move on. Another example, this time we have to look at the goodwill. What is the goodwill arising on acquisition? I know that if goodwill, I need consideration. If there is NCI, I need NCI value. Then less net assets. This is a pro forma I have in mind. Then I go look at the details. Now it says that Crashco acquired 70%. It means that 30% belongs to NCI. Of Banco's 100,000, one Ghana ordinary shares for 800,000. So here the consideration is 800. When the retained earnings of Banco were, once I see this, it means that I have to use workings 2 to determine the net assets. I have to use workings 2 to determine the net assets. Now, it says that Banco also internally developed customer list, which has been independently valued at 90, and this tells me fair value adjustment. And the non-controlling interest in Banco will adjust to have a fair value of 22. So it means that we are going to use the full goodwill method. Now, it means that we are not giving the value for net asset. We have to determine it. So if the NCI is 220, so we have 800 plus 220, that will be 1020. Now the net asset will have share capital. So the share capital, let's see, the bank's share capital is 100 times 1 Ghana, and that share capital will be 100,000. Then the retained earnings at acquisition, which is the pre-acquisition retained earnings, were given to be 570. We need that. So this is more like workings 2 that we have seen, the pro forma which we have seen earlier. Is us building the workings 2. Then we were told that there is an internally generated customer list, so that's fair value adjustment. So we call it customer list. And because it's fair value, we have to increase the value of the entity's assets. So here, the total value will be 100 plus 570 plus 90. That gives us 760. So we quickly take this 760 here. So what you quickly have to do is to see if you have left out any item. We have taken the consideration, we have taken the NCI, we have looked at the share capital, we have looked at retained earnings, we have also looked at the fair value. So we have covered all the details. So 1020 less 760 would give us a value of 260, and this 260 becomes the goodwill at acquisition. So let's see. Let me look at that again. 800 plus 220 minus 760. Let me look at the detail again. The share capital, this is 100, that is it, is here. The retained earnings is here. The customer list 90 is here. Alright, this is correct. The calculation is correct. Just that the listed answers here, the options, one of the options should be, so I can take this out and this should be 260. The answer should be 260. So that could be a typo error when developing the options. So, but currently the answer should be 260. Based on the calculation we have done, the answer should be 260. Okay. Workings number 4, non-controlling interest.